The markets never sleep. And right now, every trader, investor, and policymaker has their eyes locked on one thing: the Federal Reserve and the possibility of rate cuts. Today, we're diving deep into the real story behind the latest moves in US stocks, bonds, and inflation data, and what they mean for September's decision. This is not just noise. This is the foundation of where the global economy is heading. Let's start with what just happened. The latest inflation numbers, specifically the Personal Consumption Expenditures Index, known as PCE, came in right in line with expectations. Headline inflation rose 0.2% in July, while the core number, which strips out food and energy, ticked up 0.3%. No surprises, no shocks, just steady numbers. And in the world of monetary policy, steady is a powerful signal. It tells the market that inflation isn't re-accelerating, and it's giving the Federal Reserve more breathing room to shift policy. Now, why does PCE matter so much? The PCE index is the Fed's preferred measure of inflation. Forget the headlines about the CPI. The Fed actually uses PCE as its guiding compass. It's broader. It captures changes in consumer behavior, and it's considered more accurate for policy decisions. So when the PCE lands exactly on expectations, it tells Jerome Powell and his team that their strategy is working. Inflation is cooling without tipping the economy into chaos. The immediate market reaction was classic. Stocks in the US edged lower, not a crash, not panic, but a modest pullback. At the same time, Treasury bonds rallied, pushing yields down. That might sound technical, but it's actually the most important signal of all. Investors are positioning themselves for a future where interest rates start to fall. Lower yields tell you that Wall Street sees the Fed cutting rates sooner rather than later. And here's the headline you should care about. Markets are now pricing in nearly an 89% chance that the Federal Reserve will cut rates in September. Think about that. Not 50-50, not even 70-30, but nearly 9 out of 10. In a world driven by probabilities, that's as close to certainty as it gets without being written in stone. But let's pause for a second. If inflation is still positive, why would the Fed even consider cutting rates? After all, their mandate is to keep prices stable. The answer lies in balance. The Fed isn't just fighting inflation, it's also protecting growth and employment. The risk right now isn't runaway prices. The risk is that high borrowing costs will choke the economy, slow down investment, and trigger layoffs. By holding rates at restrictive levels for too long, the Fed could turn a controlled slowdown into a full-blown recession. That's the tightrope Powell is walking. History shows us the stakes. Look back at the 1970s, when inflation spiraled out of control because the Fed cut rates too soon. Compare that to the 2008 financial crisis, when the Fed had to slash rates aggressively to prevent economic collapse. Today's situation is somewhere in between. Inflation is cooling, but growth is fragile. That's why every decimal point in the PCE matters. And investors know it. Every hedge fund, every pension fund, every retail trader with a Robinhood account is trying to position ahead of the Fed's move. Because when the world's most powerful central bank changes course, it creates shockwaves across currencies, commodities, equities, and bonds. This isn't just about the US, it's about global capital flows, the strength of the dollar, and the future of international trade. So, what exactly does a September rate cut mean for different corners of the market? Let's break it down, because this is where the opportunities and risks start to get very real. First, equities. If the Fed cuts rates, borrowing gets cheaper, corporate financing loosens up, and suddenly the cost of capital for companies shrinks. That means more room for expansion, more buybacks, and theoretically, higher stock valuations. But here's the twist. Markets have already been pricing this in. An 89% probability isn't a surprise anymore. It's baked into the cake. So if September delivers the cut, don't expect fireworks. The real volatility comes if the Fed decides not to cut. That's when you'll see a sell-off, because markets hate being wrong. But the sector breakdown is critical. Growth stocks, especially in tech, are hypersensitive to interest rates. Think about companies like Nvidia, Tesla, and the broader AI sector. Their valuations are built on future cash flows. Lower rates make those future earnings look more valuable today. That's why tech has been on fire this year. The entire sector is basically a leveraged bet on Fed policy. On the other hand, defensive sectors, utilities, consumer staples don't benefit as much from rate cuts. They're steady cash cows. Rate cuts won't change their appeal significantly. Now, bonds. If you've been sitting in cash or short-term treasuries, this is the moment you've been waiting for. Rate cuts push bond prices higher because yields fall. Investors who position correctly in the treasury market can lock in capital gains. That's exactly what we saw after the PCE data. Money flowing into bonds, yields dipping, traders betting on lower rates ahead. For long-term investors, this is also a warning shot. The golden era of high-yield safe assets may be ending. If you wanted 5% risk-free returns, that window is closing. The dollar is another piece of the puzzle. Rate cuts weaken the greenback because capital flows chase higher returns elsewhere. If the Fed loosens while the European Central Bank or the Bank of England stays tighter, money shifts overseas. That could boost emerging markets, commodities like gold, and even crypto. Gold especially thrives in lower rate environments. It's not just a hedge against inflation, it's a hedge against central bank policy missteps. If investors smell weakness in the Fed's resolve, gold surges. And then there's housing. Mortgage rates have been brutal for the US middle class, climbing to levels not seen in decades. A Fed cut would offer relief, lowering monthly payments, unlocking housing demand, and potentially sparking a rebound in real estate. But it's a double-edged sword. If lower mortgage rates fuel housing demand too aggressively, prices climb again, worsening affordability. That's the paradox. The Fed can't please everyone. What about the labor market? This is where things get tricky. On the surface, unemployment remains historically low. But under the hood, cracks are forming. Job openings are declining, wage growth is cooling, and certain sectors like manufacturing are already slowing. Rate cuts are the Fed's insurance policy against a labor market downturn. They want to soften the landing before the layoffs begin. Remember, once job losses accelerate, it's very hard to reverse that trend quickly. Now let's zoom out. Why is September so critical? Because it's the first time in this entire tightening cycle where the Fed has real cover to pivot. Inflation is stabilizing, growth is slowing, and the political calendar is heating up. Don't underestimate that last point. We're heading into an election year. While the Fed claims independence, the political pressure to support growth without letting inflation flare up is immense. Every move will be scrutinized, not just by Wall Street, but by Washington, Beijing, and Brussels. The Fed isn't just setting policy for the US, it's setting the tone for the entire global economy. And here's the real kicker. A rate cut in September isn't just a technical adjustment, it's a signal. It tells the market the Fed believes the inflation battle has been largely won. It shifts the narrative from how high will rates go to how quickly will they fall. That change in psychology is as powerful as the cut itself. Because once the market believes in a new cycle, capital moves faster than the Fed ever could. Now, let's dig into the psychology of the markets, because that's where the real money is made. Numbers are one thing, but sentiment drives the waves. And right now, the sentiment is leaning heavily toward optimism that rate cuts are not just coming, but that they'll continue into 2025. Think about this. Wall Street isn't just betting on one cut. Futures markets are already pricing in multiple cuts over the next 12 months. That's not just positioning, that's conviction. And conviction is dangerous if it collides with reality. If inflation stays sticky, if oil prices spike, if wage growth suddenly reaccelerates, the Fed might have to pause or slow down its easing cycle. And when markets are leaning too far in one direction, corrections can be brutal. This is where risk management becomes everything. Smart money isn't just betting on cuts, it's hedging. They're long bonds, but they've also got hedges in energy. They're positioned in growth equities, but they're protecting with volatility trades. The average retail trader thinks of September cut equals stocks go up. But the professionals are playing three-dimensional chess. They're planning not just for what happens if the Fed cuts, but for what happens if the Fed hesitates. That's the difference between amateurs and institutions. Let's talk about global spillovers. When the Fed cuts, emerging markets breathe. Why? Because a weaker dollar reduces pressure on their debt. Many emerging economies borrow in dollars, and high US rates crush their ability to repay. Lower US rates give them relief, stabilize currencies, and open the door for capital inflows. That's why investors will be watching markets like Brazil, India, and Southeast Asia. A Fed cut could trigger a wave of foreign capital hunting for yield outside the US. But here's the geopolitical angle: China. The Chinese economy is struggling with real estate crises, deflationary pressures, and slowing growth. A Fed cut that weakens the dollar could give China some breathing space, especially in currency markets. At the same time, it puts pressure on Beijing to stimulate more aggressively. The interplay between US yield, monetary policy, and Chinese stimulus could set the tone for global growth in 2025. Investors ignore that dynamic at their own risk. Commodities are another battlefield. Oil, copper, gold, they all react to Fed policy, but in different ways. Oil is tied to growth expectations. A Fed cut signals support for demand, which can lift prices. Copper, often called Dr. Copper because it diagnoses the health of the economy, will be watched as a proxy for industrial activity. And gold, as we said earlier, is the safe haven play when central banks shift course. If you see gold surging past key resistance levels after September, it's not just retail traders piling in, it's institutions reallocating portfolios. And then there's crypto. Love it or hate it, Bitcoin has become a macro asset. Rate cuts, weaker dollar, more liquidity, that's rocket fuel for Bitcoin and Ethereum. If the Fed kicks off an easing cycle, expect the crypto narrative to roar back, not because of blockchain adoption, but because liquidity always chases volatility. And crypto remains the purest expression of liquidity-driven speculation. So where does this leave us with September? Here's the uncomfortable truth. The Fed has cornered itself. By signaling data dependence, they've tied their credibility to every PCE, every payroll report, every inflation update. If they cut too soon, critics will scream 1970s mistake. If they cut too late, they risk recession. Either way, markets will judge them harshly. For investors, the playbook is simple, but not easy. Stay flexible, stay hedged, and watch the data. Don't just listen to Powell's press conferences. Watch the bond market, because the bond market doesn't lie. Yields are the purest form of investor expectations, and right now they're screaming, cuts are coming. But let me give you the darker angle, because WealthX isn't about surface-level analysis. If September is the first cut in a cycle, it also means one thing: the Fed sees weakness. Rate cuts aren't a celebration. They're an admission that the economy can't handle current conditions. They're a lifeline. And lifelines are only thrown when the ship is in trouble. The market loves to cheer cuts, but history reminds us rate cuts often precede recessions, not prevent them. Look back at 2001. Look back at 2007. The Fed was cutting right as the economy was about to roll over. By the time you see the first cut, it might already be too late. That's the paradox investors need to face. So here we are, standing at the edge of September, with markets nearly certain that a Fed rate cut is coming. But what happens after? That's the real question. The Fed doesn't move in isolation. Every decision sends a signal that ripples through Wall Street, through Main Street, and across the globe. If Powell and his team deliver the cut, they'll claim it's a mid-cycle adjustment or a calibration, not a panic move. They'll frame it as data-driven, carefully measured, just enough to keep the economy steady. But make no mistake, behind closed doors, they know the risks. They know growth is slowing, they know credit conditions are tightening, and they know confidence is fragile. If the Fed cuts and the economy holds up, they'll look like heroes. Stocks will climb, bonds will stabilize, consumer confidence will recover, and the soft landing narrative will dominate. That's the best-case scenario. But what if the cut comes too late? What if credit card delinquencies keep rising? What if corporate bankruptcies tick higher? What if small businesses can't refinance their debt? Then the cut won't be a victory lap. It'll be triage. And that's where markets misjudge the symbolism. A cut can mean relief, but it can also mean warning. Think about the investors who lived through 2008. The Fed was cutting aggressively, even as Lehman collapsed. Rate cuts didn't stop the crash. They were the confirmation that the crash was already underway. That's the psychological trap, believing a cut guarantees prosperity. It doesn't. Sometimes it signals the opposite. So how do you, as an investor, position yourself? You don't chase the headlines. You read the flows. You watch the dollar, the bond yields, the labor market data. You treat the September decision not as an end, but as a beginning. Because this isn't about one meeting. It's about the cycle. Once the Fed starts down the path of easing, the question becomes, how fast, how deep, and how long? If inflation continues to drift lower, the Fed could cut steadily, easing pressure, creating a backdrop for risk assets to rally into 2025. That's the bullish case. But if inflation gets sticky, say oil spikes or supply chains tighten again, the Fed might cut once, then pause that, then confuse markets with mixed signals. And confusion is poison for investors. It breeds volatility, uncertainty, and fear. And let's not forget politics. Heading into an election year, monetary policy becomes political whether the Fed admits it or not. Every move will be weaponized. Rate cuts could be seen as helping incumbents, or as a bailout for Wall Street, or as a sign of weakness. The Fed will insist on independence, but the narrative will take on a life of its own. Markets trade on perception as much as reality. So where does this all leave us? With a simple truth: September matters, but it's not the destination. It's the signal flare at the start of a new phase. Rate cuts aren't just numbers on a screen, they're the clearest sign of where the economy stands. And right now, the signal says this: growth is slowing, inflation is cooling, and the Fed is preparing to pivot. For you, the investor, the entrepreneur, the strategist, this is the moment to pay attention. Don't just celebrate the idea of cheaper money. Ask yourself, why is it cheaper? What problem is the Fed trying to solve? And most importantly, who benefits and who loses when the cost of capital shifts? Because in every cycle, there are winners and losers. The winners are those who read the signals early, who position before the herd, who understand that monetary policy isn't just background noise. It's the invisible hand shaping wealth across the globe. The losers are those who take the headlines at face value, who think one cut means easy prosperity, who forget that every pivot comes with a price. So as September approaches, remember this: the Fed's decision is bigger than a number. It's a test of confidence. It's a bet on the future, and it will determine not just the direction of markets, but the balance of wealth, power, and opportunity in the months and years ahead. The cut is coming. The question is, are you ready for what it really means?